We're seeing a lot of volatility in the market. So we're here to spread the good word, because a lot of people don't know that they can use retirement money to invest in these deals. And a lot of people think you have to be some multimillionaire to invest directly into something like multifamily real estate. And that's just not the case.
In this episode, I traveled to the patios in Albequrqe, New Mexico. It's a multifamily complex we recently put under contract to meet up with Sean Winslow. Now, Sean is an ex-Wall Street broker who will go over the differences between investing in the stock market and investing in multifamily real estate. It's going to be great. That's up next. Welcome to Seeking Unemployment, a show dedicated to the most efficient path to financial freedom. You worked on Wall Street for some time, and so you were a stock market guy.
Correct.
So talk to me a little bit about your experience in that and kind of what that taught you about that industry and what that does for people's returns and all of that stuff.
Yeah. So just like most people, I was conditioned to think that the stock market, ETFs, mutual funds were the way to grow your nest egg for retirement. So after college, I joined a firm on Wall Street, one of the top 5 largest asset managers in the world, managing about 1.7 trillion in assets. And yeah, so I thought that, like everyone else, that was the way to invest. And I was there to help people grow their nest egg. But after a while, I discovered through, volatility in the markets, not cost effective, definitely not tax efficient, that was not the best way to grow your nest egg. And through my own learning and self-education, I came across real estate. That's the way to truly help people create passive income and legacy wealth. So I've been embarking on that ever since.
Sean and I were just here talking about why we love multifamily so much and why we feel so passionately about multifamily as opposed to the stock market as a really, really great place to put your money. Now, both Sean and I have worked in mutual funds, the stock market, basically the financial sector, trying to help people get to that financial freedom point through traditional methods. And we've both decided that multifamily specifically is just so better. So take everything we say with a grain of salt, because we're seriously biased in this department.
Well, I think it's powerful that we both have experience in both sides of, investing traditionally in the stock market and bonds, and then, investing in multifamily. We could say now we're biased, but we do have experience in both.
You wanted to talk a little bit about, I think, the current state of the market, right?
Correct, yeah.
Yeah. So let's hit it. What's the market doing right now, Sean?
Well, right now it's being driven by what we call headline risk. So the coronavirus, and also recently the drop in oil prices as well, is really hurting the market. That's the reason why it has crashed. It's not necessarily due to economic fundamentals, which are very strong in the US still. And so that has decimated people's portfolios. People who have just retired or nearing retirement, or just they're working hard and trying to build a nest egg. And that can be really demoralizing and also, hurt, where people are retired, they have to go back to work. And that's why I'm so passionate about multifamily real estate and helping people actually grow their nest egg and live, a really nice, comfortable retirement, which is why I traditionally got into Wall Street. But as I mentioned before, it's not the most cost-effective or tax-efficient way to do so. So we're seeing a lot of volatility in the market, and I think it's very important for investors to be aware that they can actually get into a deal like multifamily. And so we're here to spread the good word, because a lot of people don't know that they can use retirement money to invest in these deals. And a lot of people think you have to be some multimillionaire to be able to invest directly into something like multifamily real estate. And that's just not the case. And we want to spread the word that you can invest in something that pays a consistent cash flow to help you live the life you want. And the term financial freedom is thrown out a lot. And what does that mean to people? Well, to me, that means you're able to live off of passive income. So income that you're generating from something where you're not necessarily working, like a piece of real estate. So you're able to generate passive income that pays for the lifestyle that you want to live. And there's no better way to do that, in my opinion, than multifamily real estate.
Some of the things that I love about multifamily is accelerated depreciation and how heavily you can leverage your tax incentives to take what would normally be on paper a 12% return asset, which is phenomenal, by the way, if it was just that alone, and then just blow it up out of the water so you can not only avoid your capital gains, but you can also get amazing tax incentives to where you could seriously, and people do this all the time, pay zero taxes. If you didn't know about this and you're not shocked and amazed by that alone, then I don't know what's going to do it for you, really.
The reason why I like multifamily is for multiple reasons. One is the cash flow. I don't know about you, but I pay my bills monthly, not when I go sell a stock. They're asking me every month to pay my bill, not when I decide in 5 years I'm going to sell this stock. So
you mean you don't want to liquidate your assets just to be able to pay your bills? That's crazy.
I know, right? Am I asking for too much? Yeah. So cash flow, number one. And most of my investors, they invest because they're looking for cash flow, plus the depreciation aspect. Second is appreciation, which Shane mentioned. We're going in with value add, raising rent, so we're forcing appreciation. And then the depreciation aspect, which is the tax benefits. We're doing something called cost segregation analysis, where we have engineers come in. They're looking at every aspect of the building, whether that be the roof, plumbing, wiring, etc. And they're giving us a schedule of how they feel we should be depreciating the asset. And then we can do something called bonus depreciation, which is the big buzz term in the industry right now, where you can take that, where traditionally you had to take that depreciation amount and spread it over the life of the asset. Now you can take that all up front and give it to your investors, like where he mentioned people are paying zero in income taxes, and that's due to this bonus depreciation. And like I mentioned to you earlier, our investors last year who invested $100,000, on average, they got $40,000 in depreciation that they could offset their taxes. I know, that's wild. $40,000. So the return they're getting from the asset itself, they're paying no taxes. And then they're taking that depreciation that's remaining and rolling it over to other passive income. It's just really powerful stuff to truly build, legacy wealth and financial freedom.
So let's take a comparison from having accelerated depreciation, bonus depreciation, you've got tax sheltering, as well as your growth of your asset and your cash flows versus a stock. If you were to go buy a stock, when you go to sell that, you're going to get capital gains, taxes on top of that.
Short-term versus long-term, depending.
Yep, you're going to pay some management fees to, and that's if it's a mutual fund or something like that, or if it's somehow actively traded.
An advisor, the management fee for the advisor.
Yep.
And then the fees for the underlying asset.
Yep. And what other things? I feel like there's something else we're missing.
Well, if you're in a 401k plan, there's different, plan sponsorship fees. There are, sharing, there's revenue sharing, which a lot of people don't know about, where they're actually sharing revenue between the two entities, the broker-dealer and the fund itself. There's a lot of hidden fees that people just don't know about that, unfortunately are hindering your returns.
Let's say somebody likes what they see here. They're like, wow, that sounds like a great idea. I'd love to put some of my money into something a little bit safer. What do they have to do to be able to do that?
Well, on our deals, we structure them with something called Regulation D, private placement. And under Regulation D, there's something called the 506B. And with the 506B, you have to have a pre-existing substantive relationship, meaning if you walked off the street and asked me what I was doing and told you I'm acquiring this property that will pay my investors a consistent cash flow with a strong back end, and you were like, can I invest? Unfortunately, the answer to that would be no, because there was no pre-existing relationship. So generally what we do is we're out there networking, meeting investors, and we're growing that relationship. And then once we have established that relationship, that's when we can start showing the investor deals. And so for this deal, we're only showing it to people we've already created that relationship with.
Right. For me, I like to think of that as, we only really work with our friends,
Yeah.
You want to work with us, just be friends. It's pretty simple, pretty straightforward. And I think that makes a lot of sense because you want to always invest your money with something you know. And if you don't know the person, why are you going to hand them money? This is a very good law that helps protect people from getting into something that they don't really understand from somebody they don't really know. And I actually am a huge fan of the law. I think it's fantastic because it gives me a reason, a further reason to really establish relationships with people, which I think is wonderful.
That's what I tell investors. I always say you should be doing business with someone you know, like, and trust. And that's what I prefer. I don't want to do, even if you're giving me money as an investor and we're not, meshing, that's not worth it to me. I'd rather have someone that, we get along, we trust each other, and there's mutual respect.
We've heard the term, the money's in the money. Yeah. The way you make the money is really by putting the money in. That's kind of how I interpret it, is the people that are really making money and really making something happen for their own investment portfolio are the people that are actually investing money in it. The people that are on the GP side that are just out there hustling, like us right now, we're flying out here to New Mexico, walking the property, meeting all the people, making the connections, making this deal actually happen. That's a lot of work and it's a huge time commitment. It's really a full-time job that most people that want to be invested in real estate don't really have the time to do. The good news about that, the money is in the money, which means you're going to make more money by just investing your cash into a deal than you would by trying to hustle and find a deal out there. So,
and on top of that, as a passive investor, with the term the money is in the money, when you have the money, you have the ability to be very selective in the type of investment you want to make. Whereas a GP, you're not always able to select the type of investor you want. So with that money, you have the power to select the type of operator you want, the type of investment you want, and that's powerful.